Hi, I'm James Gerrish and welcome to another Market Matters weekly update. Something different for you this week. I've got Shaw & Partners Chief Investment Officer Martin Crabb joining me today. A couple of things we want to run through. First of all, we're going to quickly touch on market valuation, how we sit here in Australia, earnings growth and what the earnings profile of the Australian market looks like, and then touch on what's happened in the US this week after the US Federal Reserve raised rates. So Martin, just a quick overview of valuations here in Australia. Is there any sectors that sort of stand out from a valuation point of view?
Yeah, it's an interesting issue. The market looks like it's sort of in Goldilocks territory at the moment. So the figure everyone looks at, of course, is the forward 12-month PE. So that's kind of the measure to look at, and that's about 15.6 times for the Aussie market at the moment. So that's probably 1 to 1.5 PE points higher than long-term average, but given where interest rates are, that's probably about right. We've been bouncing around that 15.5 number for a number of years now, so that does seem to be right in the middle. Against that, you've got some sectors that look much cheaper than that. The banking sector is obviously one that's been under pressure, so the PEs there are sort of 12 to 13 times, and again, that's a little bit above their long-term average, but well below the rest of the market. The mining sector is now on a PE below the index. For a while there, it was well above because commodity prices were obviously much lower going backwards. So the banking sector and the resources sector now look cheap relative to the rest of the market. So given they make up about 40% of the index, you can imagine the PEs for the rest of the market. So you start to take those big sectors out and you're getting into the 20s, the 20s and even the 30s. So there's some stocks, healthcare stocks, etc., growth stocks like Aristocrat on big PE numbers. So the big sectors, the miners and the banks, certainly starting to look cheap.
But earnings growth, I guess it comes down to earnings growth. So 2017 was the year of the resource resurgence in terms of earnings. Is that going to continue, and what's the outlook or profile look for the
it really does fade away. If you move through from 2017 earnings growth, which is still in 12-13% on a calendar basis, you're looking into next year, you're looking at threes. 3 for 2018 and a little bit above 3.5 for 2019. Given we're notoriously optimistic people, we like to think that companies grow.
Analysts don't get it wrong, do they?
We sit in front of companies and the companies will tell you that things are great and they've got these great products and services they're going to roll out. So you kind of err to the side of optimism when you're looking at company profit growth. So if we're as inaccurate now as we have been in the past, it's going to be no profit growth. In fact, profits might even be lower. We're seeing lots of competition. We're seeing lots of price wars in different industries, telcos, retailing, etc. So maybe there's no growth. So, to your point about, you pay for what you get, the sectors that do look like they've got strong earnings growth, so you're looking at tourism and leisure, transport, logistics, which is really Qantas, and a couple of other sectors that are, that have got tailwinds like healthcare, they're on the big PEs. So if you look at the banking sector, I think less than 1% EPS growth for the next 2 years. So it's really flattening out going forward.
And just on the big move this week by the US Federal Reserve, very well flagged, interest rate hike over there. They've been few and far between. They've talked about it for a long time. Is this the start of a more sustained tightening cycle? And they mentioned also around tightening of their balance sheet or reducing the size of their balance sheet, which has obviously been supportive over the last few years post-GFC. What's your take on that instance?
Yeah, there's still a big disconnect, James, between what the markets are saying and what the Fed's saying. So in terms of the rest of this year, we're looking at 1, maybe 2 cuts, and that's kind of where the market's at. So we should see US rates at 1.5% by the end of the year, maybe 1.75, but more likely 1.5. It's next year that it really starts to separate. The yield curve's almost flat. The yield curve's looking for 1 rise next year, but the median dot plot, so these are the governors of the different Federal Reserves around the US, asking what they think the appropriate level of monetary policy is. So it's not really a prediction, it's just their view about where rates probably should be. And that's saying 3 more rate hikes next year. So, and then by 2019, we're looking at 3% cash rates, which is where the average Fed governor thinks long-term interest rates should be. So the issue is probably not that we're going to 3, it's how long we're going to take to get there. Your second question around the size of the Fed balance sheet, no one was looking at this 12 months ago. Everyone said, okay, it's $4.5 trillion, we know it's there, we know it's big, but they're not going to deal with it for a number of years because they need to get rates up first. They're now sort of saying they're going to start that this year. So that's probably a fair bit earlier than people were thinking. And they now actually put targets on that. but it's very, very slowly going to unwind. They're going to do 10 billion a quarter, rising to 50 billion a quarter. So $4.5 trillion is going to take them 90 months to unwind it. So it's a number of years. It's not going to be dramatic. So the bond market actually liked that, and the bond market rallied on the back of it.
It did indeed.
Yeah.
That's all we've got for you this week. Thank you, Martin, for joining us. If you have any questions, reply to this email, and we'll be back again next week. Thanks a lot.